Well, good morning, everyone. Thomas Montgomery. We get together most weekday mornings at 8 o'clock Central to talk about strategies, tips, techniques, share success stories, and support each of you. We'll have today's training and then tomorrow's Wednesday, but then we won't have training for a week due to the 4th of July extended weekend. So we have a great topic tomorrow as well. So please join us if you can. But let's focus on today, since today is today, and today, as shown here on my shared screen, is June 27th. We're going to talk about trade lines, primary trade lines. We want you to understand what they are, how they help clients, and how you can make money, how you can make money today off primary trade lines. So let's go ahead and get started. As I think you know, and we announced earlier this month in June, we have formed an alliance with a nonprofit micro lender, so third-party organization, not us. And they have made available 3 types of trade lines for our clients to use: $2,500 trade lines, 10,000 trade lines, and 100,000 primary trade lines. Now, if you don't really understand what a trade line is, then this may not sound like a big deal to you, but it is a big deal. So let's go ahead and cover and make sure we all understand what a primary trade line is. So a primary trade line is a credit account that's opened in our own name, in which the creditor, in this case, the nonprofit micro lender, extends credit as a borrower. So when you open up a credit card on your own, or you open up an auto loan on your own, or you open up a mortgage on your own, those are all examples of primary trade lines. Primary trade lines are kind of the golden ticket to better credit for a couple reasons, right? New trade lines can show positive payment history that makes the individual look more credible. And also, if they have high revolving utilization, it can immediately lower their utilization. So, for example, let's say that you have just one credit card, a $10,000 credit card for simple math, and you're using 9,000 of it. Doesn't mean that you're not current, but you're just using 9,000 of your 10,000. That's 90% utilization. Anything above 30 really brings your credit score down. Now, when we talk about these strategies, frankly, it doesn't matter what you think, and it doesn't matter what I think. It matters how the system works. So the way that credit reporting, credit scoring works is if the individual has more than 30% revolving utilization, it punishes their score. Why? The thought is that you shouldn't be using that much. Maybe you're too dependent upon credit. So we're not talking about late payments. We're just simply talking about, in this example, high utilization. But the truth is, the lower the utilization, the better the score would be. So in that example, $10,000 credit card, we're using 9,000. We're at 90% utilization. That's going to drive someone's score down by, I would say, 50 points, just because they're at high utilization. Thus, if we could bring their utilization down, their score could go up literally 50 points or more. Well, if we can get it below 30, that would be better. But our experience has been the lower, the better. If we could get it below 20%, in other words, now we only have 2,000 of the 10,000, and so forth. Well, how do you reduce utilization? Well, of course, you could pay it down, but if money's tight, that's difficult. So another way is to open new trade lines and dilute it. So let's say that someone had one $10,000 credit card, like the example we just used, using the same assumptions, and $9,000, so 90% utilization. But let's say that we turned around and put $100,000, which is highlighted here, primary trade line on their credit. Now they have a total of 110,000 available credit to use, but they're only using 9,000, which would mean 9% utilization. 9% utilization is going to skyrocket their score. So hopefully that makes sense. So primary trade lines are the golden ticket for better credit. Now you might ask, well, what's the difference between primary trade lines and what's called AU, authorized user accounts? We see lots of clients come to us and they've been sold a bill of goods. Someone told them, hey, go buy an authorized user, or have your mammy or your pappy or someone put you on their card and it'll bring your score up. It's a bag of goods, which what I mean is it doesn't really work like that. So we'll read the text on the screen and then we'll talk about it. So with an authorized user, an AU trade line, you're added as an authorized user to someone else's account, which means you're not responsible for the charges made, but the account can still be added to your credit report. AU accounts are not counted the same by lenders and often can give a false indication of credit worthiness. Typically, AU accounts are a waste of time and money. But people will go out and buy AUs or wiggle their way into AUs, because if you go to Credit Karma or whatever, it'll show your score went up. It's called piggybacking. Now you're taking advantage, and I don't mean that negatively, of someone else's credit history. Well, sounds great, right? I could put any of you right now on one of my high credit, low utilization credit cards, and almost instantly you would think your score went up. But the truth is, when we go to use our credit, lenders know better than that, and they eliminate that in almost all cases from their consideration. That's what I mean here when it's not counted. So it's a false perception of improved credit, because frankly, there's a difference between credit score and fundability. AU accounts are not going to improve fundability. It could give you a false impression that your score is higher. And I guess theoretically your score is higher, but when you go to use it, they almost always strip that out and go back and look just at your primary accounts. So you and I don't want to be involved with pitching or recommending AU accounts because they don't work for funding. Primary accounts definitely work for funding. So let's move on. So it's important to understand that selling trade lines is legal and it's a big business. So nothing that we're going to talk about is gray or questionable, illegal, or immoral. So it's okay to sell trade lines. It's legal. And so you can make hundreds or even thousands of dollars by selling each trade line. And we'll talk more about the specifics in a moment. So there are companies like Tradeline Supply, very well-respected company. I don't have any affiliation with them, but a very well-respected company. And they've been selling trade lines for years. And you can go on there and you can see the different trade lines that are available, how big it is, how old it is, and the cost to add it. So I think it's important for those of you that are not familiar with trade lines that the whole trade line transactional activities are legal, and it's a big business. It just may be that you're not that aware of it. But as a small business consultant, we allow you to pick your own pricing, and I'll talk more about that. So you're paid up front, and you pick how much you want to be paid by charging a processing fee to each client. So we have the three primary trade lines, the 2,500, the 10,000, the 100,000, just as we announced here in the beginning. And so with that, you're able to help clients plug into those trade lines, and you not only get paid for doing so, you get paid immediately for doing so. So let's cover the highlights of our new primary trade line. So not AU, not authorized user, but primary. So we don't charge application fees for the primary trade lines, but you certainly can and probably should charge a processing fee. You keep 100% of that. So let's say that you have a client that would benefit from the $100,000 revolving trade line, primary trade line. With that, how much do you make? It's up to you. It's up to you. You could charge them a $100 processing fee. You could charge them a $1,000 processing fee. It's entirely up to you. You're representing it. You're facilitating that deal. You're adding value. It's up to you. Just like if you're a realtor, right? You could charge 6% or 3% or 1%. It's up to you. It's up to you. But you would facilitate that and you keep that. Further highlights of our primary trade lines. Guaranteed approval, there's no minimum credit score. So yes, anyone can get a $2,500, a $10,000, or a $100,000 trade line. These are real. These are reporting to the credit bureau. So these have to be real. We have to follow the rules to make these real. And it's great because everyone gets approved, not even a credit check. So I guess I could have said instead of no minimum credit score, which is true, there's not even a credit check. So this is a great credit improvement strategy for clients who either need more positive credit and or, as we talked about earlier, have high revolving utilization. So often people that have dinged up credit see it wrong. They're only worried about the negative. They're worried about, oh, I need credit repair. Well, maybe they do, maybe they don't. That's not what we're talking about here. But if we don't have good positive credit, we won't be fundable. And so what you and I are doing with these trade lines is helping clients become more fundable by having a stronger credit profile. And again, it does report on credit as a new primary trade line. It's not going to report as an AU account because these AU accounts, they report differently. They show differently. You can't game the system. And so here, these are primary trade lines reporting. We have to look at the circumstances, but in some cases, they can even be added as an aged account. So as I mentioned earlier, there are 3 sizes of trade lines available. That's all there is. There's just 3. We have the 2,500, the 10,000, the 100,000. They work a little bit differently. So let's go through each and then we'll open it up for questions, comments, concerns that you have. For the $2,500 trade line, there is a 10% down payment required. So that's a matter of fact. So they'll get the $2,500 trade line. You can add whatever processing fee that you want, but there is definitely a 10% down payment required. So if you wanted to monetize this, then what you would need to do is collect from the client the 10% down payment and whatever processing fee that you want. You would keep the processing fee and you would forward to us the down payment, and then we would process the client's trade line. Now, if you just want to refer people to us and don't want to make money off of it, that's fine. And of course, you got our email and phone and all that. But if you're wanting to monetize this, it's super simple. You can offer someone a $2,500 trade line. You need to collect the 10% down from them, plus whatever the processing fee is that you want to charge. You keep 100% of the processing fee. So you're not waiting for that, right? They're paying you right now, today, the processing fee. You forward us the down payment. You keep the processing fee. Make sense? So next we have a $10,000 trade line. Again, 10% down payment required. So if you want to make money off this, you're going to collect that plus whatever processing fee you want. You keep the processing fee. Now with the $10,000 trade line, what we're doing is we're actually providing them a $100,000 debt portfolio. For those of you that have been around enough, you know that we have a program called the Collateral Support Program. The Collateral Support Program is where we are literally transferring to the client $100,000 of receivables, typically within 24 hours. Then we help them liquidate those receivables. Well, what does that mean? Well, we want to move the receivables from AR, accounts receivable, into cash. However, keep in mind, the moment that they're transferred, there's immediate value for the client because many clients we're going to run into don't have enough collateral to qualify for loans that they want. And so this provides the collateral instantly. This goes on their balance sheet. Then we help them liquidate it. Now what we're able to do, and this is the first time we've talked about this, is we can help them collect that money. And we'll go through an example just to make sure it's clear by reporting negatively on the credit of the debtors. So let's dig into that so that makes sense. So we've got Netra on here. Netra is one of our small business consultants. So let's say that Netra runs into someone like Warren. We'll just pick on Warren. Good morning, Warren. So Netra is the small business consultant. Warren's the client. Netra helps Warren get this $10,000 trade line. So she's going to collect from Warren whatever the processing fee is that she wants to collect, plus she's going to collect from Warren the $10,000. I'm sorry, the 10% down payment. Netra is going to forward to us the 10%. Netra is going to keep, you would keep, the small business consultant would keep the processing fee. We're going to turn around and send to the client, in this case, Warren, $100,000 of receivables, accounts receivables, real assets that he's going to put, we're going to help him put on his balance sheet. So now he has collateral for a business loan. Immediate benefit to Warren. Awesome. Now we're going to also help Warren liquidate those receivables. Now what we can do is say, well, Warren, let's get an invoice out to these people, because these people, we'll call them debtors. These debtors literally owe Warren $100,000 for real. So we would start by invoicing these individuals. If they don't pay, now what we can do is we can say, Warren, how about we go ahead and report it negatively on the credit of those people that aren't paying you? Because that could very well motivate them when they start seeing their credit score go down because they're having negative trade line, a negative trade line report. That could be very powerful. So we didn't have that tool before. Now we do. So any of you that are current collateral support program participants, that's a great arrow in your quiver. There'll be an announcement going out about that here in the next day or so to help you all with that. But here, as we're talking about the new trade lines, with the $10,000 trade line, they're getting the receivables. They're getting the receivables nearly instantly, which helps their balance sheet instantly. And then we help them liquidate that and turn that into cash. So it's great. Plus, it's reporting on their credit positively as a 10,000 trade line, which is why we're talking about it now. The third of the three trade lines is a bit different. It is a revolving account. The other two are not revolving accounts. They're would be considered installment. The 100,000 is a revolving account. This is a huge arrow in your and my quiver to help people, that especially those that have high revolving utilization. So again, you as a small business consultant, if you want to monetize this, you can charge a processing fee. You pick what it is, you keep 100% of it. You're going to collect that processing fee as well as the 1% down. So you'll notice the 1% down is a very reasonable amount. It's much less than the 10% on the others. So you're going to collect the 1% down, you'll forward that to us, you're going to keep the processing fee. So now they're going to have a $100,000 trade line reporting on their credit with positive credit history. So that's great. It's going to really help their profile. And again, we are providing them the debt portfolio, same as I just described. So the debt portfolio is exactly the same in the 10,000 trade line as it is in the 100,000. The difference is with the 100,000, it shows that they have a bigger trade line, because it is. Because again, we're never going to do anything that's not real, not genuine, not legal, not ethical. So when we say that we're extending through our nonprofit micro lender partner, are we really, or is it real? Are we really setting up $100,000 trade line revolving account? Absolutely. Does it really report on their credit? Absolutely. So 3 different trade lines, any of which are available. If you want to monetize this, you can. And the way that you would monetize it is by charging a processing fee, which you decide how much that is and keep 100% of. So let's open it up for questions, comments, concerns. Who has questions about this? This is a significant conversation for a couple reasons. Number one, those of you that are currently using the collateral support program, now we can even be a better resource to you to help you collect the money that's owed to you or to your clients because of the credit reporting capability. So that's a big deal. That's very positive. Secondly, we're talking about the ability for you to generate income today. not tomorrow, not some point in the future. You determine the processing fee, you keep 100% of it, client pays you, you keep that. Okay, so we got some questions here, which is great. That's the point to get together. Daphne asks, how long do they need to be in business for the trade line? There is no minimum time in business. And so just as there's no minimum credit score, there is no minimum time in business. So it's guaranteed approval. So there are no filters. Everyone gets approved. They're just simply deciding which of these three that they want. Okay, thank you, Daphne, for that. Kelly's got the next question. How long does it stay on the credit report? Stays on 7 years, just as the normal trade lines do. So it'll stay on for 7 years. And that's, I believe, established by the Fair Credit Reporting Act. So it's a permanent, it's real trade lines, and they're permanent. They're not like a rent-a-trade line, which sometimes you'll see that, like Trade Line Supply and some of these companies, and I'm not speaking negatively of them, will kind of rent you a trade line. So you get a trade line for a very short period of time. That's not what we're talking about. We're talking about primary, permanent trade lines. All right. Jose has the next question, and Jose is one of our small business consultants, but also he has his own. He has purchased the Collateral Support program, so he's asking about that. So that's right, Jose. So since you have a debt portfolio that's owed to you, you'll need to get with us, and you know how to do that, preferably email, but if not, you can call or text, but preferably email, and let us help you collect the money, liquidate the receivables that's owed to you, Jose. And we can now report that negatively on the credit of the debtors, so they're more motivated. First, we'd want to give them I don't want to say the threat, but give them the warning. So you have $100,000 that's owed to you, Jose. Let's let those people know they need to pay or make payment arrangements, or it's going to impact their credit. And so sometimes that threat is enough to motivate them. But then if they don't, then we're going to report it negatively on their credit, and then that'll really shake them up. So this is another arrow in the quiver to help what we call our debt buyers, those participants in the Collateral Support program, collect the money that's owed to them. And that's what Jose is really pointing out. This is a great deal, right? So he's only paying 10% down for a trade line that's improving his credit nearly immediately. But what's included in that is really an asset worth $100,000. Now, we will collect all $100,000, time will tell, but it's essentially paying him to get the trade line instead of him paying for it because of the expected results. All right, so Eddie asks, how do we keep up with the Collateral Support program? For example, our prospects sign up for the free funding offer. Oh, okay, great. So you're right. As we're talking right now, Eddie, we're illustrating that you as a small business consultant can offer these primary trade lines, and by doing so, you charge a processing fee, you get paid just as we described. But that is predicated on the fact that you do it. So if you do it, you get paid. If you don't want to do it, then you don't get paid. And so we can coordinate with you, but this is earned income, if you will. So if you're not helping the client get the trade line, you're not charging them a processing fee, then you're not paid for this. So it's results oriented. But for each client, we can certainly, we should be having weekly calls with each of you that are small business consultants. We should be reviewing all the clients that we have in the funding process, and that's where we can coordinate the handoff so you can go collect the processing fee from them and get them set up on a trade line, or you can just be proactive. Just go ahead and introduce it to them and close them on it. But I think to answer your question, Eddie, is we'll coordinate on a weekly basis through our calls. All right, so Netra asked a good question. So on the collateral support program, and I probably should have prepared, I guess, more content on that. We've had separate trainings for that. So let's go back and understand the collateral support program before we end today. So we came up with the collateral support program quite some time ago to be primarily to help clients have the collateral needed to get approved for funding. Because we've talked many, many times about the 3 C's: credit, collateral, capacity. Most people are so hung up on credit, they overlook the fact that we need collateral. So let's say that a client wants a $100,000 working capital loan. So when I say working capital, that means they're not wanting it to buy real estate. They're not wanting to buy equipment. There's not specific tangible assets that they're going to use it for that the lender could put a lien against. Instead, it's cash. It's a cash loan, working capital. Well, many lenders, not all, but most lenders are going to then be concerned about, well, is there collateral? Is the business worth enough to justify that big of a working capital loan? Because if the business, the borrower, doesn't pay it back, how does the lender mitigate the risk? How do they get the money back if there's nothing there? So collateral is the answer to that. So for quite some time, we've been offering the collateral support program, and it works great. We immediately transfer over the assets. It's what we call a $100,000 debt portfolio. They're real assets, they're receivables. Then we help the client liquidate the receivables. So the example I give, Netra, and I've given this many times before, is let's say that you and I start a lawn service. And so we get a contract and we go out and we mow yards, maybe for individuals, maybe for businesses, maybe for apartment complexes. Let's say it's an apartment complex. So we go mow the apartment complex. It may be $500 a week because of the mowing and the trimming. Well, they're probably not out there in the yard waiting to hand us money as soon as we finish weed eating the last sidewalk. We're going to have to send them a bill. We send them an invoice. So now that's a receivable. And then they pay that, and that goes from a receivable to cash. Same concept here. It's just we're buying the receivables. So instead of going and starting the lawn equipment company and buying the equipment, the lawnmower and the weed eater and trimmers and edgers, and instead of hiring the people to go do the work, and instead of going to do the work, we just have the receivable. We've skipped all the effort up front. Now we just have receivables that are owed. And so we're transferring $100,000 of receivables to the client. They're real receivables that are owed. And then we help the client collect those receivables. And what I was mentioning earlier is now that we have the nonprofit microlender relationship that has credit reporting, now we can use that as a tool to help our debt buyers, those individuals that are using the collateral support program, better motivate these people to pay. Because if they don't pay, not only could we litigate against them, not only could we sue them for the amount they owe, plus court cost and collection fees, we can also report it on their credit. So that is valuable. So if you're interested, any of you are interested in knowing more about the collateral support program, go to our YouTube channel. We've had multiple trainings on that. I didn't want to digress too much, but what I wanted to make sure that you understood is that with this trade line and this trade line, it's pretty much like we're giving them the trade line for free, because even though there is a down payment, of course, and whatever processing fee you want to add, we're working with them to liquidate that to turn it into cash. Just like the apartment complex that owes you and I for mowing the yard. We don't want just an accounts receivable. We don't want the apartment complex just to owe us money. We want to collect that money. So the receivable goes away and it's now cash. Cash is king. All right, well, we've covered a lot. Hopefully it was helpful, but the takeaway is this. If you want to make money helping people with primary trade lines, you can do so. Doesn't cost anything. Become a small business consultant. I think most of you are. If you're not, you can go to guaranteedfunding.org and go to the careers page, get set up to be a small business consultant. Doesn't cost anything up front, free website, free training, and then you'll be able to start offering people primary trade lines. As Eddie, I think it was Eddie mentioned earlier, We could have clients that are in access to capital that are going through the capital raise program that need trade lines, or it could just be people off the street just simply want trade lines. There's a big business in selling trade lines, as we've talked about. Now you're plugged in, you can monetize that. You control how much you make per trade line. You get paid immediately. You keep 100% of that. All right, so if that was confusing or you have questions, feel free to reach out to us. But this is a great new arrow in our quiver, a new tool in our tool chest to help clients become more credible for funding, but also to help you make more money. And that's really what we're trying to do. All right, well, we'll see you back tomorrow morning. Thanks, everyone. Have a great day. Bye-bye.